Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. From time to time, we have AMA episodes on the show. That is, Ask Me Anything. I love to answer your questions, and if you think you've got a question that would be of broad interest, send it in. I'll answer it live on the air. Send your questions to victor@victorjm.com. That's victor@victorjm.com. On today's show, we're coming to you live on location in Italy. We're about an hour outside Rome at a seaside town called Santa Marinella. I come to Italy regularly, and in the past decade, not much has changed. In this idyllic seaside town, there are numerous properties for sale, many of which have been on the market for 2 years or more. In fact, they're still talking about the financial crisis as the reason why things are so bad economically. When I was here in 2009 and 2010, I totally get why they were talking about the global impact of the financial crisis. But a decade later, I don't think you get to use that excuse anymore. A decade later, it's called the new normal, and there needs to be an acceptance of the situation that's going to take bolder steps to create more economic activity. Many of the properties we looked at were either waterfront properties or across the street from the sea. These are either single-family homes or multifamily buildings facing the water, and many of them are distressed properties with visible signs of deferred maintenance. Sellers seem to be reluctant to reduce prices, and the emphasis seems to be on the asset price, not the cash flow generated by the asset. This stands in stark contrast to the fluid notion of valuation we have in North America that values an asset as a business and that valuation is based on multiples of net income, or what we call the cap rate. This week, the local news in Italy is talking about the widely anticipated interest rate cut in Europe. This would be the first interest rate cut since 2016 and outgoing European Central Bank Chairman Mario Draghi's final move before he steps down in October. Mario Draghi's likely successor is the managing director of the International Monetary Fund, Christine Lagarde. She's a former lawyer and French finance minister. Ms. Lagarde has really no experience in central banking, although many people consider her to be a great choice for European Central Bank, pointing to her work at the IMF. I've seen her speak, and I also think she's a pretty capable individual. But it also raises practical questions about how much more the European Central Bank can accomplish with its current toolbox. The bank's key interest rate is already below zero, and its balance sheet has swollen to about 40% of Europe's economic output, double that of the Federal Reserve. I believe that with interest rates already so low, the economic stimulus that would result from lowering rates further is unlikely to have any measurable impact. Accompanying the rate reduction, it's widely anticipated the central bank is also going to participate in another round of bond buying. That's code for printing more money and then buying the bonds. Printing money could have a stimulating effect, but here too, it's like a drug addict who becomes addicted to the drug and eventually develops a tolerance to the drug and needs more and more each time in order for the drug to have any impact. So what does this mean for us as real estate investors? If Europe lowers interest rates, that could put pressure on other central banks around the world to do the same. The U.S. news media has been reporting the Federal Reserve is predicted to drop rates somewhere between a quarter point and maybe as much as a half point at the July meeting coming up in a few days. For us as real estate investors, lower interest rates are a good thing. They make the cost of doing business lower, and we can ultimately translate that into higher profits. As investors, we're seeing many markets and submarkets in the U.S. slow down. But the news tends to focus on the macro housing trends, and they rarely report on what's happening in multifamily or in commercial properties. We're seeing the lowering of interest rates as offering conditions for new development projects that might take a year or more to complete. And at the end of that year, we would be rate locking into permanent financing with more favorable rates than today. This reduces the risk of new development considerably, because we can proceed with more confidence that the numbers will work not only today, but in a year from now when the project's completed. As always, the risk is not dependent on the interest rate alone. The risk is relative to what was budgeted in the project at the outset. While here in Italy, if we don't buy that waterfront property, we may just go swimming instead. As you think about that, pay close attention to what's happening in interest rates, not just in the U.S., but around the world. Have an awesome rest of your day. Go make some great things happen, and we'll talk to you again tomorrow.